Look at your crypto portfolio. That number on the screen, what is it really doing for you? What if it could be a machine printing spendable cash for you day in and day out? I'm going to show you how to build what I call a crypto cash machine. It's a system designed to generate actual dollars you can spend. This isn't a get-rich-quick scheme, it's a get-cash-now system. It's about transforming that static number on your screen into a dynamic, productive asset. For most of us, holding crypto feels like being a dragon sitting on a mountain of gold. You've got this incredible treasure, but you can't actually use it. This is the classic problem for every long-term crypto investor. I call it the golden handcuffs. You're literally chained to your own wealth. When you sell your crypto, you trigger a taxable event. If you've held it for less than a year, you're hit with short-term capital gains, which can be brutally high. The other half is the opportunity cost. That gut-wrenching feeling of selling your Bitcoin only to watch it double 6 months later. So, if selling is off the table, what's the alternative? How do we get cash from our crypto? The answer is to stop thinking like a passive holder and start thinking like an engineer. We are going to build a machine. I call it the crypto cash machine, and it's a blueprint I've refined over years in this market. It's a 3-part system. The 3 core pillars of the crypto cash machine are the engine, the turbo, and the ATM. The engine, this is your foundation. The safest, most reliable part of the machine, built for steady, predictable cash flow. The turbo, this is where we kick things into a higher gear. It's a more aggressive component that juices your returns. The ATM, this is the magic lever. This is how you pull tax-deferred cash out of the system to use in the real world. When these 3 pillars work together, they create a financial flywheel. Your assets generate yield. That yield can be used to pay for your life or get more assets. The engine of our cash machine is the most straightforward and lowest risk component, stablecoin lending. You take your digital dollars, stablecoins like USDC, and you lend them out through trusted platforms. In return, you earn interest. There are 2 main flavors, centralized finance and decentralized finance. CFI platforms like Nexo work like normal companies. You deposit your stablecoins, they take custody, and they pay you interest. The big plus here is simplicity. Second, we have DeFi. These are protocols like Aave or Compound that run directly on the blockchain. Instead of a company, you're dealing with a smart contract. The huge advantage here is that it's non-custodial. You keep control of your funds. This eliminates the risk of a centralized company going bankrupt. As of late 2025, market rates fluctuate, but it's common to see APYs on major DeFi protocols for stablecoins hovering around 2 to 8%. Imagine you have a $100,000 crypto portfolio. You allocate 20% to be the engine. You convert that to USDC and deposit it into Aave. With a conservative 5% yield, that's $1,000 a year, or about $83 a month of pure passive income. This is the foundation we build on. Once the engine is humming, it's time to bolt on the turbocharger. This is strategic yield farming, also known as liquidity providing. You're owning a tiny piece of a decentralized stock exchange and collecting a fee on every single trade. On a decentralized exchange like Uniswap, trading happens through liquidity pools, giant pools of 2 different tokens like ETH and USDC. As an LP, you're one of the people who deposits tokens into that pool. For providing the capital, you earn a cut of the fees from every trade. The potential returns here can be much higher than simple lending. It's not unusual to see APYs ranging from 10 to 50%, or even higher. This higher reward comes with a unique risk called impermanent loss. This concept trips up a lot of people, so let's demystify it. Impermanent loss is the opportunity cost you pay when the prices of the 2 tokens you deposited move apart from each other. Your goal is for the trading fees you earn to be greater than any impermanent loss you might face. Back to our $100,000 portfolio, you might put another 20% into Pillar 2. You place this in a reputable ETH/USDC pool. If you manage an average APY of 15% after fees and impermanent loss, that's another $3,000 per year, or $250 a month. With the engine, your machine is now spitting out $333 every month. But how do we get to our main pile of wealth without creating a tax nightmare? This is the component that truly turns your portfolio into a cash machine. This is how we get spendable cash without selling our core assets. The mechanism is shockingly simple. Over-collateralized borrowing. In many jurisdictions, taking out a loan is not a taxable event. You take a portion of your core holdings, say $50,000 worth of Ethereum, and deposit it into Aave. This ETH is your collateral. Based on that collateral, you can borrow a certain amount of another asset. You'd borrow a stablecoin like USDC. The most important metric here is the loan-to-value ratio. A conservative LTV of 25 to 30% is a much safer place to live. So, with $50,000 of ETH as collateral, you would borrow $12,500 USDC. This cash appears in your wallet instantly. The biggest risk here is liquidation. If the price of your collateral plummets, your LTV will rise. This is why a low LTV is non-negotiable. With a 25% LTV, the price of ETH would need to crash by roughly 65 to 70% before you'd even be at risk of liquidation. You'll pay interest on this loan, but borrowing rates for stablecoins on DeFi are often low, sometimes in the 2 to 5% range. Let's be very clear, this is not a set-it-and-forget-it money printer. It requires active management and a healthy respect for risk. Here are the cardinal rules for operating your machine safely. First, portfolio allocation. A sensible starting point could be 50% core holdings, 20% Pillar 1, 20% Pillar 2, and 10% cash dry powder. Second, protocol risk mitigation. Use only blue chip protocols, sticking to the biggest names with the longest track records. Third, active monitoring. Set up LTV alerts. Use a tool to send you a text or email if your loan's LTV rises above, say, 40%. Finally, understand smart contract risk. This is the base level risk in DeFi that a bug in a protocol's code could be exploited. Let's watch the machine in action. The real magic is how the three pillars work together to create a self-reinforcing flywheel. You have your core portfolio of BTC and ETH appreciating over the long haul. Pillar 1 is generating a steady 3 to 5% yield. Pillar 2 is generating a higher, more volatile 10 to 20% plus yield from liquidity providing. The combined cash flow from these two pillars can now be aimed. Pay yourself, service your debt, or compound your returns. Your machine generates $4,000 a year and only costs $500 a year to run. You have a net profit of $3,500 a year, almost $300 a month. All the while, your original $100,000 portfolio is still there working for you. That is the flywheel. This is the crypto cash machine blueprint. You stop being a passive spectator and become an active engineer of your own wealth. You build the engine for safe, consistent cash. You install the turbo to boost that cash flow, and you activate the ATM by borrowing against your core assets. This system has risks, and it demands your attention, but it provides a clear path to transforming that digital number on a screen into a real, tangible source of income. This is not financial advice, and it is most certainly not tax advice. You must do your own research, understand the risks, and consult with qualified professionals. If this opened your eyes to a new way of thinking about your crypto, do me a favor and hit that subscribe button and ring the bell. Thanks for watching. Now go build your machine.